Hi, everyone. I'm Ann Sonders, and this is the September Market Snapshot. Thank you, as always, for tuning in. On this month's video, I want to do a little dissecting of the latest labor market data. Obviously, an important topic as we move headlong into the easing phase of the Federal Reserve's interest rate cycle. So last week, at least last week as we're taping this, the Bureau of Labor Statistics, or BLS for short, released the August jobs report. And frankly, at the time, it didn't help much in trying to settle the debate of whether the Fed should cut by 25 basis points or 50 basis points at the meeting this month. Now, for important background, the BLS conducts two surveys each month. The establishment survey of companies from which the payroll numbers are generated, and the household survey of individuals from which the unemployment rate is generated. Now, as shown via the blue bars on this chart, non-farm payrolls increased by 142,000. That was, by the way, weaker than the consensus estimates of 165,000, but much stronger than July's gain of 89,000. It was also the 44th consecutive month of job gains. That's historically a fairly long stretch. Now, fortunately, as shown via the orange bars, the household survey continued to rebound in August and actually outpaced growth in the establishment survey. That said, as shown via those banners, the horizontal banners, the establishment survey suggests 2.5 million more jobs were created over the past 2 years than what the household survey suggests. For what it's worth, at important inflection points in the economy, the household survey tends to represent the more accurate portrayal. Now, one reason for such a wide spread between the two surveys is the monthly birth death estimate the BLS makes associated with the birth and death of businesses. They often overestimate business births and underestimate business deaths. And this also represents a reason why downward revisions to payrolls tend to accelerate during economic slowdowns. In fact, with last week's release, July's payroll gain was revised down from an initial report of 114,000. That brought the total revisions for the prior 2 months to negative 86,000. And for what it's worth, though, it's not uncommon to see many revisions, downward revisions even, outside of a recession, with a similar dynamic having occurred in 2018 into 2019. That said, though, it's not the best sign, obviously, when revisions continue to skew to the downside. Now, as shown here, on a 3-month average basis, changes in employment have slowed significantly. And it's a trend that began about 2 years ago when the divergence between the establishment and household surveys began. If this slowdown were to persist, say, for another year, monthly employment changes would actually hit the flat line. Now, moving on to the unemployment rate, the aforementioned negative payroll revisions are occurring as the unemployment rate's medium-term trend is still up. But in a little twist, the unemployment rate actually ticked lower from 4.3% to 4.2% in the August report. The less good news is that it was the tiniest little downtick on an unrounded basis. However, it fell for the right reasons, given household employment outpaced the expansion in the labor force. In other words, the principal reason for the rise in the unemployment rate over the past year has been workers re-entering the labor force, as opposed to big pickups in layoffs. Now, as we've been pointing out recently, there are some inconsistencies with the rise in the unemployment rate, one of which is the prime age employment to population ratio. As shown here, the ratio held steady at just under 81% in August, still near a cycle high and not consistent with a recession. Now, assuming at some point it begins to move lower, it would be consistent with some sort of contraction in the economy. For now, though, this supports the notion that the unemployment rate's increase has been mostly due to an increase in labor supply, not layoffs, as I mentioned. That is also corroborated by a relatively tame trend for the percentage of individuals unemployed for more than 27 weeks. That's also known as long-term unemployment. The share actually ticked down in August, and that was the second consecutive month, which is a welcome sign given that there was some upward momentum in this series earlier this year. That said, we need to keep an eye on the continued move up in the number of unemployed individuals, given that the 6 month average of workers transitioning into unemployment rose to 3.4 thousand in August. Much like the unemployment rates trend, as you can see here, once this series picks up steam, it's unusual to see it stop, move sideways. Of course, this is a unique cycle, an incredibly unique cycle, which we continue to think warrants a granular look at all data, not just labor market data. But these kinds of moves are, for now, consistent with a weakening labor market, but not universally consistent with a recession. So, in sum, the divergence in the BLS's surveys is notable, with the household survey likely representing a more accurate portrayal of the slowdown in job growth, at least based on history. Payroll revisions have been skewed to the downside, not inconsistent with what history says about this point in the economic cycle. And although the unemployment rate did tick slightly lower last month, it is still up from 3.4% at the beginning of 2023, with a reminder that once the inflection point occurs, the unemployment rate tends to trend. But there is some good news under the hood, with the employment to population ratio suggesting the move up in the unemployment rate over the past year is due more to increased labor supply and less due to rising permanent layoffs. That said, complacency is not warranted, and the continued move up in the number of unemployed individuals bears watching. That's certainly something the Fed is keeping a close eye on. Well, that's it for this month. Thanks as always for tuning in, and I'll see you again next month.